This webinar, we're going to talk about how to trade the ORB strategy. This presentation is for educational purposes only and does not constitute financial advice. Trading involves significant risk and is not suitable for all investors. The decisions you make and the actions you take in trading are solely your responsibility. Past performance is not indicative of future results. Understand and acknowledge these risks before participating. All right, so again, if you master the first 5 to 30 minutes of the market, you can take the rest of the day off. You don't need the rest of the day. And I'm going to do my best to define what the ORB is, the exact rules, examples, some risk management, and we're going to talk about some options to automate your trades. Okay, so first, what is the ORB? The ORB stands for Opening Range Breakout. And usually you have a defined time frame. A defined time frame would be something like a 5-minute, 15-minute, 30 minutes. It could also be weird, like a 12-minute or a 7-minute. And we'll talk more about how do you define and identify those in a few minutes. But ultimately, what you want to do is you want to look for your very first candle of the day. If you're trading futures, if you're trading the stock market, obviously there is a market open, and that would be your very first candle. And essentially what happens is you draw the high and the low of the candles. So this would be your high, this would be your low, and we define that as your range. The high and the low is your range. How much did it move high and low, up and down during that first 5, 15, or 30-minute candle, okay? Now, the easiest way to do this is if you're using a 30-minute orb, you would look at a 30-minute chart. If you're trading a 15-minute orb or a 12-minute, you're looking at the chart that matches the time frame you're trying to trade. And that would literally just give you your very first candle, okay? So what happens is there's a break. So let's say your very first candle comes in and it looks something like this. You guys have all seen this, a candle that looks something like that. There's lots of different shapes, sizes. It can have a small upper wick, it can have no upper wick, you can have a lower wick or no lower wick. And the idea is you want to use this and define or draw your range based on that very first candle, okay? Your very first candle, the opening range. Now, what happens next is what defines the strategy and helps you determine if you want to go long or bullish or lower and bearish, okay? And you want to trade the direction of the break or the direction of the expansion. Again, in this case, we're not really predicting anything. We're reacting, okay? And we'll look at the mechanics here in just a second, okay? So again, if it breaks above, we're going to go long or bullish. We're going to buy contracts if we're trading futures. If we're talking about the stock market, we're going to buy shares or ETFs. Same thing lower. We're going to short and make money on the lower move, okay? So let's talk about why this works. Again, highest liquidity occurs in the first 30 minutes. There's some institutional bias inventory, and there's that compression that typically happens. And if you've ever watched the market open, it is pretty wild at times, especially the first few minutes. It can be very, very wild. And that's what we want to kind of take advantage of. We want to take advantage of the compression, right? And so here are some of the exact rules. In this case, we're using a 15-minute as an example. There are lots and lots of variations. We'll talk more about specifics here in just a minute. But in this case, we're just going to use 15 minutes and know that that will be interchangeable with maybe a 2-minute or a 3-minute or a 10-minute or a 12-minute. But for now, we'll just talk about it in terms of a 15-minute candle or a 15-minute chart, okay? So the next is we're going to wait for a break. Actually, this says close, but it's actually a break outside of the range. So we're going to wait for a break outside of that range, okay? We're going to put our stop on the opposite side of the range. So let's draw this out real quick. I do have a couple examples we'll jump into, but let's say this is my high and this is my low. Here's my high and my low, okay? So I want to wait for the next candle to go above or below my high and my low, right? I want to wait for a move or a breakout or to the upside or a breakout to the downside. Some people would call that a breakdown. And I want to put my stop on the opposite side of the range. What does that mean? Well, if I'm going lower, I want to have my entry here and my stop loss up here. Why? Because I want to wait for a lower move, and my profit target would be lower, right? That would be my take profit or my target profit, okay? Now, if price action breaks higher, I want to do this in reverse. And we'll look more about the examples of this, mechanics of it here in just a second. I got some examples for you. And the idea here is that we're able to wait for that very first candle to come in, not just come in, but close. And we're waiting or reacting to what happens next, okay? So let's take a look at and we use fixed risk. If any of you guys have maybe something like a 50K Apex or a 50K Lucid account, you guys know that you have somewhere in the middle, somewhere between $2,500 or we'll say $2,000 to $2,500 of drawdown. That means how much you're allowed to lose before the account blows up and you have to start all over, okay? So what we recommend is use a fixed risk per trade. Let's just use easy math. So let's say $100 to $250 per trade, okay? What does that mean? It means if you lose $100. If you lose $250, right? We're not risking the entire $2,500 drawdown on a single trade, okay? And then again, this kind of does imply that it's one trade per day, one orb per direction, right? Because the opening range happens once, and then price actually moves above or below that the rest of the day, okay? So let's look at some specific examples, and let's look at first our long or our bullish example, okay? So our bullish example, again, our range is drawn from our very first, we got our high and our low marked, and then we're waiting for a break above here, right? We want price action on the second candle. This would be like the number one candle. This would be like the number two candle. We're waiting for break to go, waiting for it to break above. Price action has to move above the high of our very first candle, and it would look something like this. Now, I spent a lot of time animating these for you guys so you can see how this works. Obviously, if you're doing this in a 15-minute time frame, each one of these candles would represent a 15-minute moment in time, okay? So again, our entry here, stop down below, and we're waiting for a break higher. In this case, we are in the trade and price action closes right here. Now, some of you guys may say, Matt, why are the candles white, or why are they black and white, not green and red? Well, I don't know about you guys, but I just prefer black and white versus green and red. There's no emotion in white and black. There's a little bit of emotion in green and red. So I just prefer the non-emotional version, okay? So again, in this case, step one is we are filled in our entry. So price action would close right here. And our very first candle, we got our high and our low, right? Second candle comes in, we break above, we move above that kind of greenish turquoise color line. We move above, and now we're in the trade, and we're currently up just a little bit. Profit is up just a little bit, right? From where we got in to where price action is, okay? Now, once we're in the trade, we're going ahead and throw out our stop loss and our take profit orders. How do I know to put the stop loss down here? Well, it's basically below the low of that first candle. Pretty simple, right? And what you can do is you can measure the difference between these two lines. And let's say that price action it moved roughly $10, right? The difference between our entry and our stop loss is $10, okay? So if I wanted to risk, let's say $100, and each one contract, if we're talking about futures, represents $10. I realize that's not the case, but just as an example, I would have, if I want to risk $10 per contract, and we have $100 risk, I would have 10 contracts, right? We're basically going to lose $10 and price action. If we get in here, it rolls over and moves against us. We're just going to have a defined risk, okay? Defined risk. Now, if we're risking $10 per contract, and again, we have $100 of risk versus let's say $250 of risk, that is a 250, we would have 10 contracts. We have a quantity of 10, right? But if we wanted $250 of risk, we would have 25. How did I figure that out? Well, again, the difference between our entry and our stop loss. If it's a $10 move, then we would risk $10 each and we'd have 25. As you guys know, 25 times $10 is $250, okay? $10 times $10, sorry, 10 contracts times $10 is $100, okay? So once we're in our trade, then we're gonna go ahead and put out our stop loss, again, lower here and a price up here. Now, how did I know that I wanted to risk, if I'm risking $100, that I wanna make 2 times that or 2R, well, which means if I'm risking 100, I would lose 100 if I'm wrong, but if I'm right, I would win 200, right? We would call that 2X or 2R, R meaning risky, and I'm gonna risk 100 to make 200. Is this making sense? And so essentially what I wanna do is if my stop, or sorry, the price between these two is $10, and I wanna make 2 times this, I just move this up $20. I place it $20 above my entry, and I place this $10 below. Make sense? It's one of those things where it just becomes pretty natural once you've done this about 500,000 times. Once you've done it a few times, it becomes just pretty simple. Okay, so what happens now is my next candle comes in, and again, I have automated this for you guys to see. Price action broke above, right? It kind of pulled back just a little bit, almost back to break even, went a little bit lower. So if price action was right here, ladies and gentlemen, would I be profitable? Would the trade be green or red? Would it be a little bit profitable or a little bit non-profitable or unprofitable? Which would it be, profitable or unprofitable? Bliss says red, and that would be why. That would be correct, because I got in here and price action is below where I bought it. So again, the idea here is we want to get into the trade, set up our order, get into the trade, and then set up our stop loss and our take profit. And on this very fourth candle, you'll see it actually kissed our high there, our take profit, and boom, we got in and we got out. Does it make sense? Again, this is super simplified. Sometimes if we're talking about, in this case, we're talking about a 15-minute chart, then each one of these, this basically represents 1 hour, right? If we're talking about 5-minute chart, then this represents 20 minutes, right? So it depends on, what size chart you're doing this on, and we'll have some real examples. Yep. But didn't the wick hit your take profit? Yes. Yeah, we're done. It did. So we got out right here. We automatically got out. And the idea is candle number 1, we are using a template, high or low. Candle number 2, we got in right here. And then right here, once we crossed the take profit, we got out for a profit. Even though price action pulled back a little bit, by the time it closed, we got out at our take profit. We got out at our target zone, okay? Now, there are really a few things you have to have when you get into a trade. One is where you're going to get in, or entry, where you're going to get out for a loss, stop loss, that's your breaks, and where you're going to get out for a profit. Now, I've seen people want to hold all day, price action goes up like this, and then ends up something like this. And you guys, if you've been trading any more than maybe 6 months, you've probably felt this or seen this happen yourself, where you wanted to, hold and make tons of money, and you have to have a predefined plan. That's my rule. I have to know where I'm going to get in, where I'm going to enter, where my entry is. I need to know where I'm going to get out for a profit and where I'm going to get out for a loss. I have to know those 3 things before I jump into any trade. Why? Because then there's no emotion involved. All I got to do is execute my plan, right? All I got to do is, if this happens, then I'm going to do this. If it breaks above, I'm going to go long. If it breaks below, I'm going to go short, okay? You guys ready to look at another example? Our next example is a short example, okay? Our next example, same thing. We got our high and our low. In this case, in case you get confused, you always want price action to go towards your green line, okay? So towards the green light. And in this case, we have our stop loss above, because if we're going short, we want to make money on the way down. We don't want to get into the trade and have it move against us. We want it to move lower. So we're hoping for a move that looks something like this. What we don't want is to get in and go like this. That means we got into the trade and we lost. We don't want that. We want it to continue. And that's why I always think of the orb or the opening range breakout as kind of like a trending strategy. If it's trending lower, we want it to continue lower. There are lots of strategies, some of which we'll talk about in a few weeks, that are the counter opposite of this, okay? In this case, though, what we want is we're waiting for a break below, meaning we want price action on the second candle. We'll call it candle number 2. We want price action to go below. And then at that point, our short entry is executed, means we're in the trade, okay? You ready for my animation? Here we go, boom. So at that point, we would be in the trade. And with the second candle, would we be profitable or not at this point, ladies and gentlemen? Would we be profitable or not? Yes or no? Would we be profitable by the time this candle closes? Now, yes, it's below, but again, we want price action to go lower. And the answer is yes, we would be profitable. Absolutely. Okay. Next. We'll call this our number 3 candle comes in, and price action touched our break even and then kind of pulled back. So we're just up just a little bit, a few pennies, right? Per share or per contract. We're up just a little tiny bit, right? And then again, our stop is up here, meaning if we head higher, we're out of the trade. We take our $100 or our $250 loss, somewhere in between. And ideally, you guys would use the same exact risk across every single trade. Why? Well, it makes it way easier to manage. You don't want to have a couple $100 wins and then a handful of $250 losses. You guys don't need to do, I don't need to tell you the math, but that does not work out in your favor. And again, if you're using funded accounts, you're going to start adding and accumulating some drawdown, which is the opposite of what we want. Okay, let's look at our number 4 candle. Our number 1 candle came in, number 2 triggered us, number 3 back to break even just a little bit. Price action started to reverse on us, meaning we were red, and then it kind of went in our favor. Okay, now keep in mind, if these are, let's just say 5-minute candles, each one of these represents a 5-minute moment in time. At this point, we're 20 minutes into this, right? We've been in the trade basically 15 minutes, but we waited for the first 5 minutes here, and we're now into the trade about 15 minutes. And we're almost, not quite, almost kissed our take profit level, okay? So next, boom, there we go. Would you guys agree? That was a quick, easy in and out. And of course, these are just examples. As you guys can see, that this is just demonstrating the actual, the actual strategy itself. This is something you can do. You don't need any technology. You can do this with Apex. You can do this with Lucid. Obviously, you have to have some way to enter your orders, whether you're using NinjaTrader, whether you're using Tradeovate, whether you're using TradingView, Rhythmic. There's a handful of platforms you can use to manually enter your orders, okay? So you guys are probably thinking about this. Okay, Matt, you showed us like a bullish, a bearish, a long, and a short example. How do I know which way it's going to go? Like, how do I know which direction to use? Like, I don't know what's going to happen on candle number 2. I understand candle number 1 is like my template. How do I know what's going to happen in candle number 2? And that is actually a very, very good question. And that is what makes this strategy super simple. That is, you use what's called an OCO, order cancels other, or a bracket order, right? Which basically means you're going to have an order that's set up to go either direction, right? You're going to have an order that's like, you know what? Whatever happens next, we're going to be long if it goes above. We're going to be short if it goes below. And you could put that order in ahead of time. As soon as this first candle, number 1 candle closes, you can go ahead and get into a trade and set up that OCO order. Every single prop firm that I've ever seen supports this. Is a little bit of a sophisticated order. Every single prop firm I've ever looked at And use myself personally allows this. And typically what you would use is like a stop limit order, right? A stop limit buy or a stop limit sell. And what does that mean? Well, it means that at this point, I need to wait because at the close of the candle, price action closed right there by my blue X, right? And it's probably likely to go below, but you're not guaranteed. But it's much closer to going below than it is turning around and going above, right? Now, if you guys have been trading again more than 6 months, you've probably seen some wild things, some things that you thought were guaranteed wins or guaranteed losses that reversed and actually went in your favor or moved against you very, very quickly. And the idea here is we're going to use stop limit buy and stop limit sell orders. What does that mean? Well, these are very specific order types. And what happens is I'm waiting for price action to cross my red line or my blue line, right? Again, this is my high, my low. I haven't really picked a direction yet. I just realized this line shouldn't be red. It should just be like the turquoise because I don't know which direction, whatever happens next, I haven't picked a direction yet, right? Again, this is OCO. And there are some companies like Apex that don't like you actually having an OCO order or a bracket order. Always think of a bracket like this where you have your long and your short order. And whatever happens next is what you're going to do. You're going to go long or short. Apex, they don't discriminate against. They just say you should pick a direction, which is kind of silly. You can pick a direction and then 2 seconds later you can pick a different direction. But anyways, here's what happens is let's say the short order is executed. It's automatically going to cancel the long order, which means if you get in here, it's going to automatically cancel this one. Okay. So if you go short. Now the same is true in the opposite, which means if your long order is filled, it's going to automatically cancel your short order. Okay, so that's the power of you don't have to get in front of it ahead of time. You immediately can set up the order very, very quickly once you know what your high and your low are for the first candle. You can set up your high and your low. It's pretty simple to get in, to get out. Now, you guys want to know what is the hardest part of the strategy? I'm curious if you guys know what's the hard part? And it's actually not the strategy itself because the strategy isn't hard. What is hard is discipline. The discipline is what is hard. So things like changing your size after a loss. So if you're risking $100, you take a loss. Now you want to do $500 because you need to make it up, right? So getting in and out, getting in and out are already predefined, right? So let's go back. So we're predefined. Your stop loss, your entry, and your take profit. Those are all defined before you get into the trade. Same thing long and short. It's predefined. It's a predetermined outcome. You're either going to win or you're going to lose. One of those two is going to happen, right? And again, because we're looking at the very first candle of the day or the very first candle of market open, the odds that it's just going to go sideways all day is very low. It's super rare for that. I've seen it a few times in my 10, 11 years trading. It's very, very rare. Usually what happens is it goes something like this, like all over the place. It's very rare for it to go sideways. But jumping in, of course, and kind of making your risk, changing your risk, changing your size, upping that because you take a loss and you want to make it back in your next one, that's kind of what we're referring to. And the other thing is most funded account programs, especially Lucid, Apex, Top Step, have some kind of, sometimes they call it a DLL, a daily loss limit. What does that mean? That means there's a set amount of money that you're allowed to lose in a single trading day, right? Now remember, with Apex, you can lose on a 50K. So in Apex 50K, you are allowed to lose $2,500. But that doesn't mean you're allowed to lose it all in one day. And I don't remember what their limit is, but maybe let's just say, for example, it's $1,000 per day, right? So obviously, if you take $500 risk and you have 2 trades, that you're at your limit. And both trades lose, you're at your limit. So what we're saying is don't do that. Don't risk $500 when you're allowed 2,500, because it's kind of like five shots, right? 5 shots at $500 each. Now, if you lower it, if you lower it to maybe 100 to $250 of risk, you have a lot more attempts, right? And again, the idea here is not to have some huge windfall. Some people call them hero trades, some massive trade that you make tons of money on. Why? Because most funded account programs will say, oh, congratulations, you made some money. We're going to deny a payout, meaning we're not going to allow you to withdraw money because you broke what's called a consistency rule, which means, and they all have slightly different rules, but basically somewhere in the neighborhood of 30% of your gains, any one trading day should not be more than 30% of your gains. What does that mean? If you have a massive trading day, and I thought this was per trade, I myself have been denied payouts before I realized how this piece works. So very, very important. If you're using a funded account, your consistency rule means you cannot have gains that add up to more than 30%. Okay. So again, you have to be consistent over time. You can't have some huge windfall, take some huge risk and make all your money in one day, because they will not let you take any money out if that is the case. Why? Because they consider gambling, right? Especially Apex. Apex has some interesting rules. They consider gaming. You're gaming the system. You're gambling, right? They have all kinds of fun words to describe this. All that to say, they don't allow it, okay? So, again, trading inside the range, which obviously if you have your very first candle, it has to break above or break below. You don't want to do anything in the inside the range, okay? And then trying to constantly change up your time frames is not helpful. Ideally, stick with a plan and follow it. So let me clear my screen here and let's talk about the next piece, which is your risk management. Again, we're just using examples, Apex, Top Step, Lucid, Bluesky. There's probably more than I can even name. There are a lot of funded account programs. They all have different account sizes. This is my favorite. 50K is my favorite. Now, yes, there are, Apex has 300K accounts. They have 25K accounts. My favorite's 50K. I feel like I've been a broken record talking about why I like 50Ks. They're a little easier to get funded. Growing your account $3,000 with 2,500, this is almost a 1-to-1 ratio, right? It's fairly easy, right? But when you get into the 300K account, you need, it ends up being 3-to-1, meaning you got to make $3 of profit for every $1 you're allowed to lose. As you guys can imagine, that becomes significantly more difficult when you have to not make $3,000 profit, you have to make a 20K profit. That becomes significantly more difficult, right? It's like the difference between walking on a sidewalk and walking on a tightrope. They're similar, but they're very, very different, okay? You're walking, but it's just very, very different. Again, that's why I prefer get something you can get funded fairly quickly, fairly easily. It's not a delicate balancing act, okay? So in this case, a $50,000 target, your profit is $3,000, your trailing drawdown, which we talked about, was $2,500. Your daily loss limit, your DLL, daily loss limit, is $1,000. And you're risking $100 to $250 per trade. Now, if there's some examples here, if you're risking $250, you make 1R, you would make $250. If you're risking $250 to make 2R, that would basically be $500. So how many $500 wins do you need to make $3,000? You need 6, right? And again, this is net wins. So what is a net win? Well, imagine you win 9 and you lose 3. Your net is 6, right? Again, 6 times 500. So 2R wins, risking $250. You would be right at your profit target. That's the idea here, okay? Is that you're able to set this up and risk the same amount every single time. Whether you win or you lose, you're going to risk the same amount and be consistent. That's one of the things that we like to preach a lot at Push Button Trading is consistency over time. We've seen people try to shoot for the moon, make a ton of money on day one, get close, blow up, have to go back and start all over. Why? Because they were trying to game the system. They're trying to hurry up and make it work, right? But at the end of the day, you're going to have some losing trades and some winning trades. And what are you going to do when those trades lose? Are you going to stick with your plan, or are you going to abandon it and go chase some new strategy? Most people feel like if I take a loss, I did something wrong. And I will tell you, just like the Super Bowl, just like any not Super Bowl, but any pro sports team, you can absolutely give it your best and you can still lose, right? You can play hockey, you can play baseball, basketball, football. You can be on the field giving it your absolute best. And the other team just maybe they're a little better, right? Maybe they just got lucky. Maybe it just wasn't your day. And a lot of people feel because I take a loss, I have to do something different so that I never, ever take a loss ever again. And I just learned, you know what? Guess what? It's part of doing business. You're going to lose sometimes. Doesn't mean you're worthless. Doesn't mean you know what you're doing. It just means you lost. That's it. There's no deeper meaning to extract from it. You know, a lot of times people internalize it. They're like, oh, what my dad said about me when I was younger, it must be like, it's just a loss. That's it. It's nothing more. It's pretty simple. Just part of doing business. Okay. So in this case, let's talk a little bit about the psychology or the emotions behind like doing this trading manually. Okay. Now you can absolutely do this. We've talked about it so far manually. Obviously, if you've never done a trade like this before, hesitating at the entry is a challenge. Or if you got your order in late, or you know it's starting to move higher and price is already up here and you should have got in down here, right? Or you want to double your size after a loss. These are all very, very, very common things that we see happen a lot with manual trading, or canceling your stop loss. That's one of my favorites. Tracy, we actually got asked that the other day. Can I just, if the trade is losing, can I just cancel my stop loss? You can jump out of a plane without a parachute if you want. We highly don't recommend you do that because that's how you preserve your account and continue to trade another day. Now compare that to like what we prefer, which is like systematic trading. We're not doing this manually, we're systematically doing this, right? And we're going to execute the rules exactly. We're going to keep the risk, the size, all that the same every single trade. And then we're going to put our stop loss exactly where we planned it. And it doesn't matter what happened yesterday. It doesn't matter what's going to happen tomorrow, next week. It doesn't even matter if you're in a bad mood, right? Systematic or automated trading is kind of what we prefer, and that's where it's at. So just hypothetically, what would happen if this was executed automatically? That's where we're going with this. Like, we're not trying to sell you anything, but we do have some technology we built that actually takes this as well as 8 total strategies and have automated it. But what if the risk was fixed, anywhere from $100 to $250? Again, relative to that 50K account size. What if you didn't miss the breakout? What if you didn't oversleep? All the things that the manual traders struggle with, this technology can solve, okay? And then, as you guys know, you can have up to 20 accounts with Apex, up to 20. And they do offer anywhere from Apex has anywhere from a 25K to a 300K account. You guys can do the math. 20 300K accounts is some horsepower, right? And some firepower, okay? So again, that's kind of some thoughts. And just, wouldn't it be cool if you could automate this? You're absolutely welcome. You can do this on your own. You don't need us. And we're planning to teach a lot of our in-house strategies that we've built and adapted and modified over the next several months. We're going to be doing webinars just like this every couple of weeks. And here's where this is going, okay? What if you didn't need discretion, you didn't need emotion, and the technology actually executed the order for you? Like the calculations, the order entry, the risk management is input by you, a setting, what if that was all taken care of? And again, you can go up to 20 accounts. We actually have something called a trade copier that lets you trade one account and copy it. So you can trade it in one account and copy it into up to 20 accounts total. So the trade copier is built in. It's pretty nifty. I use it myself. And then what if you had defined risks? So instead of sometimes using $100, sometimes using 500, as you guys know, 100 and 500 is 5x variant, right? And then what if you're able to see how well things have worked across your account? Again, that's kind of what we offer at Push Button Trading. And what I want to do is I want to show you guys, if you guys want to take some notes on what are the, oops, let's do it this way. What are some things, some time frames, some tickers that we have learned that work really, really well, okay? And we actually have 8 different trading strategies. So we have 8, we'll call them 8 bots, 8 strategies. And we offer about, it's somewhere in the neighborhood of about 300 predefined settings, okay? 300 predefined settings. Now, what I wanted to do was I asked our team to put some settings in here, some things you guys can look at and play with yourself and see how well this works over time. So what we have here is M and Q on a 2-minute chart. Again, I can pause here if you guys want to take a screenshot of this. M and Q on a 2-minute chart starting at 6:54 a.m. Now, all of these times are PST, Pacific Standard Time. I realize we probably have people here from 30 different times. Well, I don't know. Are there 30 different times? We'll say a lot of different time zones. Right, so these times are all in PST, okay? So if you're in Central Time Zone, add 2 hours. If you're in Eastern, add 3 hours. If you're in Mountain, add 1 hour. Again, M and Q 2-minute chart, okay? And this is saying Tuesday and Wednesday. Then M and Q on a 3-minute chart starting at 5:30 a.m. Monday, Tuesday, Thursday, and Friday. Now, how did we get all these? Well, again, we have some technology that runs on NinjaTrader, and it's pretty powerful stuff. And we can go back in time and we can run a 4-year back test. Now, I'm curious, how many trades do you think occur in a 4-year time frame? If you're doing one trade a day, one and done, give or take, what's your best estimate? How many trades per day? So basically, how many business days are in a in a 4-year period? Does anyone have any guesses? Yeah, 240 per year. Yep. Now keep in mind that there are some settings like trailing stops and some other things that might be in here, but I want you guys just to see some variations because this is not all set in stone. There are some variations in here. 3-minute, 12-minute, 14-minute, 8-minute, 12, right? So I want you guys to see, this is just an example, M&Q, MES, again, across the board here. There's some examples of what has worked well, again, with a back test in 4 years of 4-year back test. And essentially it comes out and it's somewhere close to 4 years is somewhere in the neighborhood of about 960 to 980 trades. If you guys were to manually review 960 trades to see what worked, how long would it take you to review that many trades? Well, what if we put it in software and it took 3 minutes for us to review almost 1,000 trades? 3 minutes to tell you each one of these, like what the versions are, what the ticker, the time frame, the days of the week, okay? Again, these are examples, and that is kind of what we have. We do have a automated program, and again, I'm not trying to sell you anything, but I will, if you're interested, let me know, and I can easily send a video that explains more about our technology. Again, this is not a sales webinar. We're not selling anything, but I can share a video if you guys want to learn more about our technology. Again, the purpose of this webinar was to explain one of our strategies. Again, we have 8 of them, 8 bots, 8 strategies. This is, we'll call it number 1 of 8. That's what this is, number 1 of 8. We'll be teaching the next 7 over the next every couple of weeks. Any questions? Questions, let me know. Yep. Hello, Miguel. Good to see you again. Can you teach the strategy to be automated? If you're talking about this exact strategy, this is one of those we've already automated. So I'm not sure what you mean about teaching it to be automated. Yeah, I'm not sure. I'm not sure what that refers to. Yeah. Maybe, did I misunderstand your question? Yeah. Oh yeah, the ORB strategy. Yeah, absolutely. Yeah. So what I'll do is I'm going to go ahead and put a link here into our chat pane. Let's see. Sorry, let's do it this way. There's a link. And it's basically a webinar that I did a couple weeks ago. I want to say right after around Christmas time. And we actually have a portfolio of tools. Again, not trying to sell you guys. If you want to go watch the video, I think it's maybe 30, 40 minutes that goes over in depth the actual technology that we offer at Push Button Trading. So go ahead and take a look at that. Any questions, any other questions? But again, this is my preference, is to use technology to help, even if it gives me a 2 or 3%, just a little bitty edge. And then I can use that technology in funded account programs. I don't have to risk my own, I don't need my own $50,000 account, right? I can go pay $23 a month for a $50,000 account with Apex with their 80 or 90% off sales. And I can do this, get an account funded, pull money out, get more accounts. You guys see? And then snowball the process. But what other questions you guys have, please let me know. Otherwise, the video kind of explains how that works. Yep. Now, what are some other advantages of backtesting automatically versus manually? Oh, there's a lot. How many of you guys have ever practiced back trading, right? So let's say you were to use a tool like TradingView. They have a bar replay, and you were to practice and go back 4 years. I don't think you can go back on a 5-minute chart 4 years in TradingView, but let's just say you can. Imagine being able to run a back test automatically. So instead of manually taking this, imagine doing this in NinjaTrader, being able to see an actual report with like statistics, with graphs, with charts, and then combining multiple back tests in a single. This is what we refer to as a bot portfolio. Yeah. And again, all of our technology is built on NinjaTrader. And as long as the funded account program supports NinjaTrader, easy. We got this. Yep. And you can do this this strategy orb on pretty much any platform. You can do it on Schwab. You can do it on Interactive Brokers. You can do it, of course, on NinjaTrader. You can do it with Apex. You can do it Tradevate, Lucid, Top Step, Rhythmic, all the things. Yeah. Will email questions, have some, yep, ready to, yeah, absolutely. So there's my email, ladies and gentlemen, Matt at Push Button Trading. Thanks for hanging out with us. Let us know if you have any other questions, but that is all I have for you guys today. Thanks for hanging out, and I will get this recording posted. Thanks. Have a great day. Bye.